Look, managing risk in multi-asset portfolios isn't some comfortable task you can delegate and forget. It's a brutal, non-stop battle, and if your syndicate isn't ruthless about how it approaches risk, you're bleeding money and bleeding trust, and you might not even see it coming. The truth? Most founders and investors out there are asleep at the wheel. They stuff their capital into a dozen assets, pat themselves on the back, and say, diversification done. No, just no. That's gambling disguised as strategy. The pain of watching a once promising portfolio crumble because no one wanted to nip risk in the bud is real, and it's avoidable if you get serious now. First, ditch the idea that risk is a static number you can measure once and leave alone. Risk lives. It shifts, sneaks, and strikes when you get complacent. Syndicates managing multi-asset portfolios know this. They don't just diversify blindly. They wield dynamic correlation models like weapons. You want the truth? Correlations between assets aren't fixed. They heat up in crises and cool off in calm markets. Ignore this shift, and the first shock can wipe you out. So, step 1 is obsess over real-time data, not last quarter's report. Push for systems that track how assets move relative to each other right now. If two assets march in lockstep, even if they're from different sectors, your diversification is a lie. Second, make liquidity the bloodline. You'll see many syndicates drowning when assets freeze and exits vanish because they didn't stress test liquidity scenarios. Your portfolio should be designed assuming a sudden liquidity crunch. That means having clear cash buffers, layered exit options, and not putting all your eggs in long-term illiquid bets without a backup plan. Profoundly, you must structure deals where partial exits are possible, where syndicate members can step out without firing shots that crush valuations. If you don't embed liquidity discipline, you're building a house of cards. Third, risk appetite must be a living document, not a dusty slide in a quarterly meeting. Syndicates don't just set it and forget it, they calibrate constantly. If a sector tanks or geopolitical shifts hit, your appetite has to shrink before your portfolio feels the pain. This means honest, sometimes brutal conversations about what losses are acceptable right now. If you need to scream at your partners to get that on the table, do it. The alternative is denial disguised as hope, and hope drains portfolios faster than markets. Fourth, never overlook behavioral risk within the syndicate itself. Ego, fear, overconfidence. They kill deals harder than market crashes. The best syndicates have tough, transparent governance. They set clear roles to challenge assumptions and stop herd thinking. If everyone nods along, you're already dead. Your job is to force dissent, make debate brutal, and keep egos in check, so decisions are cold, calculated, unclouded by emotions no one admits they feel until it's too late. This internal risk kills more than outside factors. Lastly, embed scenario planning with mental toughness. Risk management isn't only spreadsheets, it's mindset. Syndicates that survive multi-asset turbulence build muscle through game plans for worst-case scenarios. Rehearse those crises. Know who does what when markets freeze, valuations plunge, and partners panic. Mental toughness is the unseen asset that dictates whether your syndicate folds or fights back. Build it or be ready to fold. This isn't a checklist for comfort. It's a brutal call to reality for every syndicate managing multi-asset plays. You're not just protecting capital, you're protecting your reputation, your tribe, your future. It demands obsession with data, liquidity, discipline, ruthless governance, and mental toughness. Do these things, and you don't just manage risk, you conquer it. Ignore them, and trust that your competitors and the merciless market will enjoy the wreckage you leave behind. Now is when you make that choice loud and clear. Subscribe to our YouTube channel and open the featured link to learn more.